Hey guys, I'm Heather Vole with Vole Squared and Remax Excalibur, and I'm here today with Alex Shelton
with Academy Mortgage.
Today we're gonna talk about some real estate related things. I know there's so much involved in the mortgage and the buying of the home and that whole fun process. So we like to find some topics that we can bring up to you guys that might be useful. And today we're gonna talk about private mortgage insurance.
Everyone's favorite.
Yes. So obviously we know that there's your mortgage payment that includes the principal, the interest, typically some escrows and your home insurance to help balance those out at the end of the year. But sometimes there's also something called private mortgage insurance, and not everybody knows what that is. So Alex, why don't you talk a little bit about that?
So private mortgage insurance is something that you pay as a buyer if you're putting less than 20% down. So it's a third party that's gonna collect this private mortgage insurance, not the bank, and the buyer is paying this third party to insure the bank against you as a buyer defaulting on that loan.
Okay, so it kind of protects that person who's made the investment that makes the loan possible for you.
You got it, exactly.
Awesome.
So in a worst case scenario, buyer defaults on the loan, the bank gets 100% of their investment back.
That's pretty smart. Makes it a lot easier to make loans for people, doesn't it?
Exactly, and you don't have to put the 20% down, so it's actually something that you kind of want.
Okay. I do think it's a little bit more complicated than that, and I think you're going to explain that to us today, but we're going to do it while we play a game of shuffleboard, correct?
Let's get to it.
Awesome. Okay, so disclaimer, I have never played shuffleboard today, so I do not want to be responsible for my score.
I won't consider myself a master, but playing more than once, I think I got a little bit of a leg up today.
And I will
so ladies
add,
first.
I will add, so these are red and blue Remax colors. Awesome. Okay, so while I take my turn, we talked about private mortgage insurance, like pretty much what it is. You know, it's attached to your loan, it's an extra payment, it goes to the person, an outside party outside of the person who's carrying the mortgage, right?
Yep.
So like what exactly, like how does that protect that person, or what's the incentive for the private mortgage insurance?
So the incentive is that you can buy a house with less than 20% down. Back when my parents were first buying homes, you had to put 20% down.
Okay.
So a group of people got together and said, how can we make it a little bit easier for first timers or people with less available cash to get into a house?
Okay.
So they created these private mortgage insurance companies. So now you can pay this private mortgage insurance company if you don't have quite as much skin in the game to buy a house.
Okay, so back in the day, you mentioned it used to be 20%, and now obviously we see different loans, 20%, 10%, 5%, and sometimes even if you're lucky, you get in with a down payment assistance or USDA loan where it's 0%.
Yeah, you got it.
So essentially having the private mortgage insurance open that up.
That's right, yeah. So as a first-time home buyer on a conventional loan, which is what I'm gonna speak to most of our conversation today.
Okay.
Oh, short, oh, short. Oh.
So I've got one, so do I just do this?
Not yet, so we'll both throw and then we'll calculate the points because some of them might cancel out. So since we both got one, we're both at 0.
So you think you're gonna cancel out some of my points, huh?
I'm gonna try. So 3% down as a first-time home buyer. And a first-time home buyer is just somebody who hasn't purchased a house or owned a house in the last 3 years.
Okay. And that's an opportunity as a first-time home buyer. They can put the 3% down and still qualify for a solid interest rate on that, a good payment, and the bank's not going to require them to have the 20% down.
Exactly, and you'll just have that added mortgage insurance payment, which is not for the life of the loan.
Okay.
See, look at that.
It's really just until they have about 20% of their own equity into the home, isn't it?
Yeah, so there's a few different ways to get rid of this mortgage insurance.
I saw that, by the way.
Yeah.
That's not very fair.
That was a little sneaky, I know. There's a couple ways to get rid of that mortgage insurance. So I mentioned it's not for the life of the loan. So nobody wants to pay it forever. Most mortgage insurance companies require that you keep it for a minimum of 2 years. So you make 24 on-time payments. That's when you can start asking, how can I get rid of this? So if you have at least a 22% equity position based on your original purchase price, they're required to take it off automatically.
So if your home has progressed in equity because the market has improved, does that also go towards that potential to have that removed?
But I will say, do not leave it up to the banks or whoever's servicing your loan to take care of that mortgage insurance for you.
You need to call and get asked.
Take control of it yourself, all right? And work with a mortgage professional that's helping you keep an eye on it.
Okay.
So when you do have that equity, that natural appreciation, you can just get an appraisal. They'll send you a list of appraisers. You send your appraisal off to the servicing company and they will wipe away the mortgage insurance as long as you have at least 20% equity there.
So let's say you buy, market improves, you have equity in there. It doesn't have to be before the 2 years. It could be within that 2 years too, the first 2 years.
So some servicers require that you still make a minimum of 24 payments.
Okay, so now you've owned the home for 24 payments. You think you might have a little bit of equity into it. You call your bank, you hire an appraiser. Let's say an appraiser costs, about $800, $800 to $1,200.
Yep.
That $800 to $1,200 in that appraisal that you just hired, dang, you're kicking my butt, is going to take off that PMI, that
Correct.
monthly payment for you for the life of your mortgage.
Correct, yep.
So it's definitely important to pay attention to what the market is doing, the equity that you have in your home, and to talk to your local real estate agent. They can help you find all that information out about.
That's right.
It's awesome.
Yes.
Cool. So I have a question before we move on, because
Yeah.
I know there's so much more about PMI.
Yeah.
So to recap, we've talked about the PMI on the insurance is something that's newer to our generation of mortgage because our parents were required to put the 20% down and
You
stuff.
got it, yeah.
They also saw a lot higher interest rates.
True.
Is that a good reason why we're seeing lower interest rates in our generation of mortgages versus the 18-19% that they would see?
Yeah, so we've had some unique things that have changed rates.
Okay.
And a big part of that is the introduction of the 30-year mortgage.
Oh, okay.
So because of that 30-year mortgage, we've had an opportunity to drop interest rates.
Okay.
So
we've extended the mortgage, we dropped down the interest rate, it makes the payment more affordable, they can afford a bigger home,
That's
and
right.
it's more of a stable situation.
Exactly.
That's very cool, I like that.
Yep.
Okay.
Because the home prices back then, were quite a bit
Lower
less than they are now.
But their interest rate
But their
was
interest
more.
rate was higher and their payment was a little bit more. So there's sort of a balance. to
Evens
that.
it out.
Exactly.
I like that.
Yep.
Okay, so we talked about 20% down, that removes your PMI or relieves the need of even having it. We've talked about that PMI going to a third party that's not the one that's originating the loan.
Right.
And then we've talked about after 24 months with on-time payments. I noticed that word on-time payments.
Very
I'm sure
important.
that's huge.
Yep.
So let's talk a little bit more about how you remove it, or can you pay for it up front?
Yeah, so
Me or you?
it's
Sorry.
you go right on ahead. Yep. So removing it again with the refinance.
Okay.
If you wait long enough, it will drop off automatically. If you're in an FHA style loan.
Okay.
So let's talk about that a little bit because there's a difference between mortgage insurance PMI and a conventional loan versus an FHA loan.
Okay.
So on an FHA loan, you're required to have mortgage insurance. It's not private mortgage insurance, no matter how much you're putting down.
And that's because it's a government-backed loan, correct?
Right, so they're
Okay.
much more lenient on employment, on credit, so they want their money because they're really
They're
sticking their
hey,
necks
we're going
out.
to take the risk on you. We're going to give you this mortgage, but we want to make sure that you can afford this payment and that you're going to be okay in the longevity of this
Exactly.
30-year mortgage.
So we're going to extend you risk, but you're going to extend to us more money in the mortgage insurance. So you have an upfront mortgage insurance payment, which is added to your loan amount of 1.75% of the loan amount, and then you have a monthly payment as well.
The PMI.
Right.
Okay.
So
1.75 up front. You could typically pay that off with closing costs.
you could, absolutely. If you're getting a concession from the seller instead of adding it to your loan, you can have them take care of it for you.
I like that. That's
Yeah.
very cool.
It's a
I think
great
it's your
use of a
turn.
concession. All right.
I think
little
we're
too much
both not
grease on
doing
it.
very good on this.
I don't think either of us should quit our real estate careers
Yeah.
and go shuffleboard full time.
Oh, neither of us are on the board right now. Let's just note that, okay? Okay, so we talked about with the FHA that there's two types of the insurances that are on the mortgage.
So you're right, you have the upfront and the monthly.
Okay.
And on an FHA loan, it's there for the life of the loan if you put less than 10% down.
Okay.
If you have put more than 10% down, it'll go away after 11 years.
11
So
years.
still
what
not-
makes that 11 the magic number for that?
Just whatever FHA, the Federal Housing Administration, decided.
We're talking Fannie Mae, Freddie Mac,
Exactly.
all that stuff.
Yep.
Awesome.
So refinancing out of that FHA loan is going to be really what you want to do to get rid of it as quickly as possible.
And you can refinance from FHA to conventional.
You sure can.
Obviously, you're going to have your closing costs with the refinance.
Yep.
Most likely an appraisal to find that equity that's in the home and make sure that we're still within our means of doing so. But it'll also probably alleviate some of that payment too.
Completely, yeah, because the mortgage insurance on an FHA loan is typically higher than a conventional loan.
Okay.
And what really changes the payment on private mortgage insurance is down payment. How many borrowers are on the loan is a risk factor. And then also credit score is a really big weight.
Oh, you can typically get approved for an FHA loan before a conventional, depending on your credit score.
Correct. So
conventional is a little bit harder to do.
right. So if your credit is, needs some work, then an FHA loan may be less expensive for the MI portion than a conventional loan.
Because you're a little bit more of the risk, but it's government backed.
Correct.
Perfect.
Yeah.
Okay, that's pretty cool.
Yep, so I always say we want to try to keep you in conventional territory because that mortgage insurance can go away without you needing to refinance. But if something's going on credit-wise and we need to steer you to the FHA loan to qualify, then it's better than not getting a house.
So mortgage isn't a no, it's just let's try this route.
Let's take it one step in another direction.
Very smart.
Yeah.
Okay, so let's paint a scenario.
I think I'm
Yep, let's paint a scenario. I come to you, I'm a buyer. I've got that great credit score, I've got that great income, I'm ready to go. I'm gonna give you 20% down. I can't even get to the other side of the board right now. Let's not forget
a little more
So I've got 20% down, or let's say I have 20% down, but I wanna talk to you and be like, hey, I kinda wanna use maybe 10% of that. I think we gotta switch sides, don't we?
Yeah, we do, yep.
So I wanna use 10% of that to like maybe do some floors in my house and some cabinets. So while I've got the money, I don't want to use it all down, but I also don't want to pay PMI.
Yeah.
So can you paint that scenario for me?
Yeah, that's a really great question and a scenario that I do see pretty often. Just because you have the 20% doesn't mean that it's the right way to go to just try to avoid mortgage insurance. Mortgage insurance isn't evil. You can make a lot of payments.
Everybody thinks it is, by the way.
But you can make a lot of payments with the 10% that you're going to save.
Okay,
Or
so
put towards
like putting
furniture or
10%
whatever.
down on a mortgage, I can actually still be in a very comfortable payment. Like say I'm at a $400,000 house, I put 10%, I'm very good with that. I'm gonna keep the other 10% that I would have had and done something down with it.
Yes.
But I'm still gonna have PMI on my mortgage because I'm only at 10%, not 20, correct?
Right, so let's keep the math easy. So like let's say it's a $100,000 house, we both know that those don't really exist. But just to keep the math easy for everybody,
Sure.
$10,000, it's a fair amount of money.
Sure.
But when we're stretching that over 30 years, it becomes dollars.
Minuscule.
Right, exactly. So taking that $10,000 and using it towards furniture or keeping
Quality
it in
of life in the
reserve.
home.
Right,
Yeah.
yeah, I call it sleeping money if you need something that helps you sleep
Rainy
at night because you got
day
some
or-
reserves. Yeah, exactly.
Yeah, because it does take some time for some people to accumulate $10,000.
It absolutely does.
Oh.
Yeah, ooh, I'll take that shot all day long. Let's see the
think that's
defense.
cheating.
Let's see the defense. I think this is my side. I can't seem to get it down there all the way.
Oh!
You're going for it though.
I was. Okay, so I come to you, I got the 10% down, and I say to you, hey, I want to put 10% down on the home. I'm capable of 20, but I'd like to keep some of that. But I don't want to pay PMI because I
Yes.
definitely think that I, qualify. I've got great credit. I'd like to see the scenario, and I want my mortgage payment to be a couple $100 less a month. What do you recommend?
So if that concern is the monthly payment, we can always front load that mortgage insurance and you can pay one lump sum up front as part of your closing costs instead of that being paid monthly.
Okay.
So the benefit to that is that the average number of payments that you're making on that mortgage insurance is something like 102 months. If you just let it go naturally and you're focused on only paying down the mortgage and you're basing it on what you bought the house for, it's gonna take about that many payments for it to come off naturally. Right.
Okay.
So if you front load that and pay it off, you're gonna save about half those payments.
So typically in a scenario like that, are we talking a couple thousand or are we talking tens of thousands?
It's gonna be a few thousand, and it's all based on loan amount. So it really just depends on what size property you're going for.
That's not bad.
Yeah.
So again, back to that, the closing costs, because a lot of people don't understand what closing costs can cover, and we call them, oh my Lord.
Snuck it by, oof.
We call them closing costs and prepaids. And the prepaids is because you can have a lot of things like your appraisal covered, maybe your first year of homeowners insurance covered from those prepaids. But closing or you're buying down your PMI can also be too.
Correct.
And a seller can do that, can't they?
So we covered that with the FHA loan. They can cover that upfront mortgage insurance for you. And this way too, on a conventional loan, you could have them cover that as well. So what I see a lot of times is the actual closing costs versus what is allowed for a third party to pay for. The closing costs don't get to that max amount.
Okay.
So if we're
there's
looking,
still room we could negotiate
there's room.
for.
So how do we get creative to maximize that full credit from a seller, right? Doing that PMI is
asking the seller for some concessions.
Exactly.
And I know right now with a lot of the change in the market, we're seeing some prices drops on some homes, and I think it might be way more beneficial for a buyer to come to a seller.
Knock me out.
For a buyer to come to a seller and say, instead of taking the price off the home or maybe negotiating $5,000 to $10,000 less on the price of your home, you can help me with my mortgage by paying off my PMI.
Exactly.
Let's, figure this out.
Yep.
It's awesome.
Absolutely.
Well, I'll tell you what, I think we both suck.
I think we both should never play this game again, or at least maybe not without a couple of beers.
Right, I would agree with that. But I think we had some great conversation about PMI mortgage. I know I learned quite a bit today, and I think hopefully our viewers will be incentivized to discuss PMI with their lender, hopefully Alex, their lender, over what's the best scenario for them. So before we wrap it up, is there anything that you would like to share to just like bring it on home about PMI, or maybe tell us a little bit about yourself and how to get in touch?
Yeah, I would say just don't be afraid of PMI, and it's important to work with somebody, hopefully myself, that can give you all of your options. So what is it like paying the MI up front? What does the monthly look like? Can we wrap it into the rate? And just really covering all those options so you can make the best decision for your personal financial situation. And to get a hold of me, if you're in Arizona, I lend here, California and Colorado as well. We'll leave my phone number.
All great markets, by the way.
Yeah. Okay. Maybe we'll leave my phone number in print somewhere.
I'll make sure that we got the number in the comments below for you guys. And how about if they search you on Facebook or give us a good email? Yeah,
you can look at the Alex Shelton team in your Google bar, and I should pop up there. And I'm on Facebook, YouTube, Instagram. I'm all over the place. You'll find me.
Awesome. Again, we appreciate you guys taking the time to watch our videos, and we thank our guest Alex for joining us today. I'm Heather Bull with Bull Squared and Remax Excalibur, and you can find me on YouTube. We're also on Facebook, Instagram, now TikTok, and everywhere else. So if you guys have any questions about what the market is doing in real estate, or maybe there's a topic that you want to see us cover, feel free to reach out. Thanks guys for watching. Have a great day.
We won't have a rematch anytime soon.